What's the matter with Valeant, the pharmaceutical company based in Canada? The stock was $257 a share, now it's $34. We'll take a look. If you own Valeant, the pharmaceutical company based in Manitoba, Canada, you might be in the mood to take some of its prescription medications because it's been a wild ride. What's that ride been? The stock was trading at about $10, $20, $30 a share, and all of a sudden, within the space of less than a year, it went to $250. Everything was great, the company was a genius, the shareholders were happy, and then what happened? The bottom fell out. It went from $257 to about $31. Let's take a look at the chart. It looks like Mount Everest, or if you live in Europe, Mont Blanc. It's just a big, sharp decline. Why? What happened with the company? A number of analysts, journalists, other people commented on the accounting practices of Valeant. I'm not going to get into it on this program. Needless to say, they questioned the booking of certain revenues on the company's balance sheet. Was that enough to knock the stock from $250 to $31? It was, and it was a dramatic, sharp fall. But the shares are now trading at an all-time low. If before you believed it was a great company with great market share, with the ability to market in ophthalmology, gastrointestinal disease medications, and other products, maybe now's the time to jump in. It's certainly at 2 times earnings. You're never going to find a company this big, this successful, this cheap. But a company that's gone from $250 to $31 can also go from $31 to $3. So let's not get ahead of ourselves. What's the risk with this company? I'll tell you what I think the risks are. I have no privy information. I don't know anybody at the company. I don't own the shares. I think the risk with this company is just uneven performance. It was losing money from 2010, 11, almost to about 2014, 100 million, 300 million. They were booking losses, and then all of a sudden, they showed almost $1 billion in profit. Good management, good company, good products? Yes, that was what the story was. It may still be the story. We haven't heard the end of how the investigation into Valeant has gone. But the fact of the matter is, one year you're showing a loss, next year you're showing $1 billion profit. The stock goes off like a Roman candle, and nobody quite knows why. Now it's at 34. It's come back a little off the bottom. Is it sustainable? I can't answer that. I have 2 questions about Valeant, leaving aside how they book their sales. One is they have goodwill of about $6, $7, $8 billion and intangible assets of 20. They also have long-term debt of 20. Now that long-term debt may be at advantageous rates of interest, and it may not pay off, may not need to be paid off for the next 4 or 5 years. The fact of the matter is, you've got long-term debt on one side, you've got intangible assets and goodwill on the other. And to me, that's a kind of a mix for unhappiness and disappointment. I don't like goodwill on a balance sheet of a company, and I don't like debt supporting goodwill on a balance sheet. It's tied into acquisitions, and you can say it's tied into revenue, but there's a need to show a lot of kind of positive earnings when you've got such numbers on your balance sheet. So that's a concern for me. And I think I might give a stock like this a miss. It's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.